Investing Insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
Hello everybody, back again. Steve Waters and Victor Kumar from Right Property Group for another Investing Insights videoed version, which we do on
Every fortnight?
Every fortnight. I should know because I do turn up.
Well, it's actually once a month, but we feel it comes around really quickly because we do the audio version with Phil, and then we come and do this in our studios here with the recorded version, the videoed version.
And the Facebook Lives.
That's right. And obviously, we don't want to involve Phil in there because he's got a radio a head made for radio, doesn't he?
Well, see, you just lined yourself up for the next time we go into those studios.
I'll be sledged.
You'll be sledged. You'll end up crying. We'll have to comfort you.
Yeah, I know. You know what? We've got a better looking person this time around. We've got Sze Chuah from MLS Finance.
We do.
He's top 30 broker in Australia and all-round good guy. And the reason why he's an all-round good guy is because he's also a client, isn't he?
Well, he is, but importantly, he's an investor as well. He's an investor as well, and we'll cut back over to Sze in a minute, and we'll talk about everything, all finance, but also some general chit chat. But before we get to that, let's just talk about some of the major things that have happened over the last 2 to 3 weeks. And whilst we understand that this content won't be evergreen, we might look at it in 3 years' time and say, remember then, the year 2020, which they'll talk about for 1,000 years. But there has been some major events over the last couple of weeks. Obviously, we've got Melbourne Stage 4 lockdown, some of the outer lying areas, Stage 3 lockdown. We've got a spike in cases throughout New South Wales and some of the other territories and states. And what that's done, it is instantly affected the economy, and the ramifications may be widespread for the short to medium term, but we play the cards we're dealt with. We can all point the fingers and have this blame game, if you will, but at the end of the day, life goes on, dare I say it.
That's right. And I think we've become used to it, right? Because this is lockdown reloaded, so to speak, right?
2.0.
2.0. And people this time around are going in a lot more prepared mentally. And they know that it is business as usual so long as employment is not impacted. And if you look at the figures in Melbourne over the last week in terms of auction clearance rates, while the number of auctions were down, the clearance rate was sitting at 83%, which is pretty important figure in terms of gauging the mentality and the psyche of the buyer. And equally importantly, non-auction properties, 1,130 odd sales, non-auction for that week. And when you compare that to Sydney, which was 1,340, the market is still continuing because, first of all, there aren't enough properties on the market to begin with. And more importantly, there are more buyers out there in the market than there are properties. And in fact, one of the things that you were talking to me about earlier today, Steve, was the searches online.
High intent search, And I think if we come back a step though, with the Melbourne auction clearance rates, like it is a smaller sample pot, so it doesn't take too much of an instance to change the data. Nonetheless, the intent is there, and that's what you're referring to in terms of the search intent. And so Domain and realestate.com have high search intent data, which is showing the amount of people that are coming back repeatedly on their platforms to look for property. And the interesting stat there is it's actually higher than what it was this time last year. And that's a really important, I suppose, topical point, because this time last year we were over the election.
Yes.
So there was a lot of that pent up, potential scaredness for investors on who was going to win the political race, so to speak. And then when Liberal retained government, we saw an instant spike in search intent, transactions. We had price growth as well, and yet today the high intent search data is higher today than what it was this time last year. And I think what that does is it shows people's where they sit between their ears.
Yeah. So in other words, it's business as usual, or people are also looking at this because a lot of people are a lot more well informed nowadays in comparison to, say, 10 years ago. In terms of the GFC, 10, 15 years ago, in terms of the GFC, the information wasn't as smooth flowing. Now it has got its pros and cons, right? Because the information is quite easily transferable via good old Facebook.
Because it's true.
Yeah, that's right. If it's on Facebook, it has to be true. The good, the bad, and the ugly get transferred really, really quickly. And the more informed purchasers, such as the listeners to this podcast, they're looking at it and saying, okay, where's the opportunity? Because money is really cheap, and the opportunities do abound. And people are still needing to transact. And if you go back all the way back to the Great Depression, properties were still being transacted at that point in time as well.
Yeah, and to those who could get finance, which we'll talk about a little bit later on. But what's really important, or what's really interesting, I should say, to study and watch and try to interpret is actually watching the infection rates be mirrored by the transactions. Yep. It's because it's around mobility. I mean, let's not for 1 minute though put aside the severity of the virus, the ramifications of the virus, whether it be health, employment, and the like. But we can start to track the infection rates with the transactions as well. And once again, as I just said, it comes back to mobility.
Yes, it does.
If we can get around. Having said that, though, the online auction portals have done well. You know what? I can't get into that.
I can't either. I have to have that physical.
Yeah, exactly. I mean, the result is the result, but I don't know if I'd be potentially too happy bidding online unless I had to, and clearly that's the scenario that we have today.
You've got several things working against you, right? First of all, is you're totally dependent on the technology actually working for you. So in other words, your internet connectivity. And if you're living where I'm living in terms of acreage and you're living, the internet is scratchy at best at times, right? So obviously we need to be in the right area to bid on it. But the most important thing for me from an auction point of view is actually not being able to truly read the body language.
I can't read the body language on the buyers, the auctioneer, the sales agents and the like. What I equate it to is, and I'm sure there's not too many people in the world that haven't had a crack on, say, eBay. And you get that, when you're bidding on something on eBay and there's like 30 seconds to go and you've got that whole sort of emotional tempo thing happening. Amplify that with a couple more zeros, or a lot more zeros on $500,000, $1 million purchase.
There's a lot riding on it.
There's a lot riding on it. And I wonder if there's that technology around, I think they call it sniping technology, where at the last millisecond the killer bid is put on when you think you've been successful at bidding on whatever the widget is, to be smacked in the face with 0.01 second by someone with better technology than you. I wonder if that's possible with property.
Yeah, it could be.
Hence, I don't like it. I just, there's nothing that beats being at an auction to suck up the vibe, see what everybody's doing, put your best foot forward in terms of negotiation, because auctions are still a negotiation.
Negotiations on steroids.
Well, it is. There's a lot more sort of moving parts to it, if you will. So we're starting to see, if we go back a couple of steps, we're starting to see that this pent-up demand is every now and again surfacing. So it's not as though, what I want people to understand is just because we have higher infection rates, people aren't putting their plans on the shelves. They're not saying, well, now I'm out of the market. It's just they're stepping out of the market for a very small moment in time, whether that be around mobility, finance, or the like. So it's not, no, I'm not buying anymore. It's more about, well, I'll just have to wait another week, another month, whatever it may be, and they're re-entering the market. And we can see the transaction numbers going with that. In fact, one of our buyers agents was went through some open homes on the weekend, of which in one part of Sydney there were 31 groups. Now that is not a soft market.
No, it's not. Yeah. So this is the true markets within market scenario.
Correct.
Where we've got some areas where you're smashed with inquiries, other areas where the inquiries aren't as robust, but there still are inquiries there, and some areas where the price is actually going up rapidly, and other areas where they're not going up as rapidly, or they're actually faltering.
Yeah, and a lot of it now also comes down to the relationship with the agents, especially around mobility. So we're not talking about off-market properties, because you may or may not have heard us talk about that before, but we think that's a great marketing gimmick for the most, but pre-market is proving very important. And those that have the relationships with the different agents are starting to be able to sneak around the sides and secure the property.
Before it hits the net.
Before it hits the public net.
Yes.
It might be within the database, but before it goes public, so to speak. But none of this means anything unless you have finance.
That's it.
At the end of the day, all intent means nothing.
Yeah.
So luckily we got the expert
Yeah, so
in the
drum
room.
roll. Here's Sze Chuah.
That's
Hey
it.
guys,
How have you been, mate?
Pretty good.
What are you seeing in the market now with all the work that you're doing with all investors and homeowners and the like, and business for that matter?
Yeah.
What are you seeing in terms of the tempo of the market and intent?
There's a lot of intent there. So it could be one of the different, various few types of intent. So it could be a client trying to consolidate and just improve their interest rates and repayment structure and cash flow for their portfolio. Or it could be an opportunistic investor. You know, you guys know the like very well, but thinking it's a great time to buy. They've got the means, they're cashed up, they've got the servicing capacity, time to go out and hunt. But the one category that I'm seeing a lot of now, and this is probably a reflection of where we're at in terms of a business and our client base, is a lot of investors that have traditionally been sort of growing their portfolio steadily over the years. They're looking to buy the owner-occupied, and it's probably the highest proportion of owner-occupied transactions that we've done ever.
Yeah, right.
So that's, I guess, the interesting part. And you know, to your point about intent, I think the whole working from home, isolation thing, people are starting to realize how important their homes are.
Correct.
And they're like, you know what, this is where I'm going to be most of my time instead of being in the office.
Yeah.
The
The intent's there. And maybe that's the other reason, if we dig deep in the intent data, maybe we're seeing a spike in that because people are working from home, so they don't have their bosses looking over their shoulder. They could be a little bit, they don't have to be as secretive, maybe. I don't know. But it's interesting to see.
If any RPG employees are listening to this,
It's pretty hard. That's their
know
job, so they're on real estate.
Yeah, that's
they're on real estate 24/7.
That's where I was going with that.
It quickly closed down the screen. But it's interesting to see that people are now shopping the rates as well, because there are some legacy rates, if you will, where people have their head buried in the sand, or they just don't know what they don't know, and
or they've been fixed in.
Or they've been fixed in, and
Yep.
I can put my hand up for a couple of million of that. Looking very much forward to that sort of finishing. Circa 2% difference, just saying.
Well, in some circumstances, we're finding it's actually worth investigating the break fee and breaking, because if you're getting a significantly better rate in today's market, plus you're getting some rebate thrown at you, then in some cases we're actually seeing it's worth actually breaking the fee. In other cases, you know, especially if you've only just done the fix, then, it's not, or it's just very much level peg.
What about, let's explore that a little bit further, because I had a client yesterday who had roughly 8 months left on the fix, but the difference was nearly 2%.
Yeah.
You know, what you could get today versus what they're paying.
Yes.
Yes, there's a break fee.
Yeah.
How much, let's call it just for round figures, 1.5% over circa $1 million.
Yeah.
How much more are we amplifying the borrowing capacity by actually breaking the fix?
That's a good point, isn't it?
Yeah.
It is a good point. It will significantly change the borrowing capacity. So let's just say on 1.5. Did you say 1.5?
1.5 mil, yeah.
Yeah. So 1.5 mil. Say 1% on that. If you're looking at percent on that is significant amount. What, 15 grand in terms of just interest repayments, and that would easily equate to an extra, because that's going to be post-tax as well. That'll easily equate to an additional 25 grand worth of gross income that you'd have to be earning to cover for that.
Correct.
So that will help borrowing capacity.
The borrowing capacity, and I think what we're seeing from our clients anyway is that not a lot, but some people just can't get their hands on enough money, and I say that quite loosely, but the difference between being able to borrow enough for investment grade versus, well, I can't quite get there, that might be something that's worth entertaining, as long as the numbers, which is what you guys do, run it backwards and forwards and inside out to make sure that it's still a viable proposition with the break fees.
Yeah, and then if you take our investor hat off, I suppose it also would be that if you restructure your mortgages, it may help you qualify for that principal place of residence that you're vying for, that you can't actually qualify taking a standard approach. Yeah. Sometimes with finance, as you'd agree, Z, that there needs to be perhaps a take a step backwards to move 2 steps forward, right? So you take a hit in the initial stages by refinancing and restructuring the debt.
Sure.
So that it sets the platform so you can then move up in the scheme of things.
Gives you the liquidity, the future borrowing capacity, as you said, and the flexibility to extract equity or what have you.
Yeah. So when you're talking about restructuring and setting the platform right, there has been several changes. If you go back all the way back to last year with the Royal Commission and even with the COVID now. What are some of the really strong changes that have happened in finance? Generally, if we just take investors and owner-occupiers approach together, what's the major changes that have happened?
Well, the major changes is that there was a series of, around when COVID started, there was a series of interest rate cuts. And that was critical, obviously, for people's repayments and the interest expense that they're paying, but also for their borrowing capacity. Because nowadays the borrowing capacity isn't done based on an arbitrary 7.25% assessment rate. It's based on the actual interest rates that you're paying or you're going to be paying, plus a buffer on top of that. So the fact that those dropped, we had 2 or 3 successive cuts. That meant that instead of looking at a 3.5% principal and interest rate, you're looking at a 2.5% interest rate, and your servicing capacity increased significantly. Now that was counterbalanced by the other forces of, because of COVID and the impact to people's jobs and their businesses and types of employment like casual and so forth, contract, lenders became very apprehensive to those industries and job types and so forth. So there were some tweaking of policies in all different types of lenders, but we probably saw it most at the sort of the lower tiers, so the non-bank lenders.
Yep.
Because of the size of their book and the impact to them, we saw massive knee-jerk reactions. So overnight changes to policy, for instance. We'll call it a well-known third tier, was giving out unlimited cash out. We were getting approved for unlimited cash out. Overnight, it became a cash out of $20,000.
Yeah. So let's explore cash out. What does that mean?
Yeah. So that means that when investors are looking to utilize the equity of an existing property that they own and leverage that to buy another property, they've got a couple of options in terms of how to do that. They can give both properties as both the existing property and the new property as security. That's known as a cross-collateralization. It's something that we've spoken about before. We
try to avoid
like the plague and or the virus. And then the other way is to take out a loan against that the equity of the existing property, and have it still stand alone to the new property, but you're taking out a loan on that and effectively cashing out, so borrowing.
So making the equity liquid.
Correct. Yeah. So if you're cashing out $100,000, you all of a sudden you've got a new $100,000 loan against your existing property, and then you'll have $100,000 sitting in the bank or in the offset or wherever it is, and then you can use that as the deposit and the purchasing costs for the next property. So that's obviously not as palatable to lenders as the whole cross-collateralization scenario. So whilst it's still allowed, they have more stringent rules around it. And as I was saying, overnight it went from like if it makes sense commercially to the lender, we'll do $1 million if you've got enough equity and servicing capacity to do that. We'll give you that $1 million as a loan and as cash
To do whatever you want.
or well, for the
Within
purpose
reasons,
of
for the investments.
for the investment purpose. So, but instead of that, it went down to, and we were doing that. You know, in the weeks preceding that, we were getting cash outs of $500,000, 400,000, 600,000, and then overnight, the no exception policy was a maximum of 20,000, and that's nothing if you're looking to
So
buy
if
another
you
property.
wanted to get more money, you'd had to actually produce a contract.
Contract.
That's where the money's going, so that they'll give that cash out directly linked to that purchase, isn't it?
Yeah, correct.
And so there's many fickle moving parts, if you will, to today versus what there was tomorrow, or yesterday, I should say. But what we do know is that the serviceability calculations, or the proverbial handbrake, if you will, from APRA from years ago, has now been released somewhat, allowing more money to get into the economy, or the ability for people to borrow, and therefore getting that money into the economy. Because if you look at the first homeowners today, with their multiple free kicks, depending on which state they're at or in, this time last year, there would have been a bunch of first homeowners that couldn't service or have enough money to service a particular loan amount, whereas today they can.
That's right.
And then you overlay the free kicks, if you will, and then overlay another component where in some areas it's cheaper to own it than it is to rent it. Then what we see is a lot of first home owners in the market, and therefore we see a lot of first home finance.
Yeah. See, one of the things, in my opinion, is going to create a problem years down the track, probably 5-7 years down the track, right? Because me as a first home buyer, I'm getting in and there's minimal of my money in the deal, right? So there's minimal of my hurt money in there. Most of it is government incentives and all that. So I'm going to stretch and leverage to as high as I can get. And let's say 5 years down the track, we have issues paying the mortgages and all that. I wouldn't be afraid to let go of the property, right? This is me thinking out loud as a first home buyer, right? Because I really haven't got any hurt money. Yes, there's some time invested in this and all that. So there is likelihood that there will be some casualties of this when they haven't done their sums right, when they get into it. And that's where a good broker comes into play, because when someone sits down in front of you, you actually map out a good finance plan for them to begin with, isn't it?
Yeah, absolutely. And taking that scenario a bit further, that might be something that's I've seen a couple of clients really utilize these government incentives to good use to be able to grow their portfolio, because it may be, let's put down as little as possible in terms of deposit and leverage that home, but their real intent is to turn that into an investment over the years, and effectively they've really leveraged a lot of their finance, and it's sort of, they've kept the actual deposit aside in a separate
future
account.
purpose.
And they've sort of maintained that liquidity. So
I think
if you manage it well, it makes financial sense.
Well, I think
doesn't
that's
it?
what the government's relying on here, that there's an element of education around this, and that the general Mr. and Mrs. Smith, or Bill and Mary, have some sort of financial literacy to understand what the ramifications are, what the possibilities are, just as important. But it doesn't take away from the fact that they need the money in the economy. They need to stimulate the economy, and in this case, it's via the building and property industry, which has
always been the case.
which is 17%, as we've talked about before, of total GDP. So it's a big part of the economy, and the powers that be, if you will, are saying we need the money in the economy, and this is just one lever that they can pull, because to be fair, they're probably running out of other levers. So they need to do what they can to stimulate the economy. So Vic mentioned a finance plan, if you will, and one of the things that we've always seen is that the successful investor has very good structure, so very good finance structure. And behind every good finance structure is a financier/broker that is actually putting together the plan. So rather than just the one property, because any broker can do that, to be fair, and so could the 18-year-old across the other side of the counter at one of the banks. But what separates the good from the bad is the structure moving forward, or the forward thinking, if you will. So we're thinking 3, 4, 5 loans ahead as best as we can, taking into account some assumptions of what the lending environment's going to be at that point in time. But at least we start with the right, well, good broker will start with the right intention.
Yeah. So it's about figuring out what the client wants to do. So and their risk appetite. So if the strategy from a property investment perspective is to grow the portfolio very quickly over a very finite period, say a 3 or 4 year period, buying 10 properties, 15 properties, it's very different to buying one property every 2 or 3 years, right? So the advice around how do we leverage it? What kind of loan to value ratio? So what deposits are we putting down? Are we putting down the stock standard 20%, avoiding the cost of mortgage insurance, or are we going to push the lever and go 90%, or even better 88% and borrow the mortgage insurance, or are we going to go up to that 95% and really push the envelope because the client is extremely high income earner but is capital poor? So as you said, it is really about thinking about the long-term objectives, the long-term plan, the client's current situation, and also it could be about their potential situation in 6-12 months. If they're in the military and they're going to be deployed overseas, or they're expecting massive promotions or career growth over the next few years, we need to structure that appropriately, take that into account, and all the decisions from a finance perspective need to marry up to the property strategy, to their situation. So things like, as I said, the LVR, things like, are we fixing, or are we being a little bit more flexible with a variable setup? Are we going principal and interest, or are we really trying to preserve the cash flow and potentially the future borrowing by going interest only? So all of these considerations need to be made at that point in time, as you said, for the properties 3, 4, 5 down the track.
So they're different scenarios, which is really a map out.
Yeah.
And that's important, as opposed to just going over the counter and hitting buttons and saying yes or no, you can borrow X, Y, Z. And that's certainly not taking away anything from all brokers across Australia, but unless they have that element of sophistication around themselves, then how can they give that advice going forward? But you mentioned in some of those points you just said there, loan to value ratio, LVR positions, 88 plus LMI and all the like. So one of the questions that we get asked a lot is, what's the difference, and apart from the obvious, I'll preface that, between 90% loan to value ratio and 88%? There's a lot of 88% recommendations at the moment.
Yeah. And the reason for that is because that's a sweet spot for borrowing. Lender's mortgage insurance is typically charged by tier. So 80 to 85% might be 1.2%. 85 to 90 might be 1.3%, and then 90% plus 1.5%, and 95% is 2%, for instance. So the reason the 88% works is, take a $500,000 property purchase. If you're borrowing 90% and then paying the mortgage insurance yourself, that could be about $9,000 for the mortgage insurance. Sure, it could be a cost of doing business, whatnot. But if you were to borrow 88%, so put down a 12% deposit and then borrow the mortgage insurance on top of that, it's still effectively a 90% loan. But instead of paying $9,000, you're paying $6,000 or $6,500 as the LMI.
Capped?
You're correct, capped. So the difference between a 10% deposit plus paying the mortgage insurance, or borrowing the 88% and then capping the mortgage insurance is actually very, very little.
Right. So when you just explain cap though, so what you're talking about, that you're actually
borrowing it on top of it. So it's an 88% loan on the overall property. They'll lend you that, but you're also borrowing the mortgage insurance or capitalizing it.
So you're potentially preserving capital, your own capital.
Correct. Yeah.
Right. And so the reason that I asked the question is because we're starting to see a lot of it, and people that might be wanting to leverage, and this is not financial advice, but if they're really looking to preserve capital or leverage the capital that they have, then 88 plus LMI capped might be something that they may entertain. Although not every lender is going to offer that.
Some lenders, especially again the non-banks third tiers, when it's not a mortgage insurance and it's more of like a risk fee, as in like the lender effectively insures themselves, but charges you a risk fee. A lot of the times that might be a linear or just a proportionate kind of thing. So it doesn't really matter whether you're going 88% or 90% plus. So yeah. Do the calculations.
Yeah. Do the different lenders have got different insurance premiums in that sense?
Yeah. Good point. They do. There are two main mortgage insurers out there, Genworth and QBE. A number of other lenders, including some of the majors, they do their own insurance. So they all calculate it in a different way. And correct, some of the lenders have, some of the different insurance policies have different insurance premiums, and even amongst different lenders with the same mortgage insurer, just say Bank A and Bank B with Genworth, it also depends on what the pulling power of that bank is, how much they actually pass over and insure with Genworth, because they may negotiate a better premium than clients of Bank B that don't do as much with Genworth.
Yeah. So it would be akin to saying that if they've got more buying power, then their premiums lower.
Yeah.
Plus also if they've got a relatively clean book, in other words, no claims, they may be lower, isn't it?
Yeah, correct.
Yeah.
So there's a couple of other questions that come to my mind, and I'm asking this on behalf of the listeners and our clients that we talk to. So there used to be profession discounts.
Yes.
If you will. Are those
Correct.
profession discounts still available, and who are those professions?
Yes, they are, but a lot less than they were, say, 6 months ago before COVID all started. So the main category of professions is the medical profession, so generally doctors, GPs, specialists, and so forth. It does extend in some cases to vets and pharmacists and physiotherapists and so etc. So health professionals, one category. Another category are solicitors and lawyers, so barristers, legal profession. Another one is accounting and finance professionals. And there's a couple of others like engineers and sports people, entertainers, and so forth. So there are a few different categories, and the main benefit over the years of this is allowing them to highly leverage without having to pay the mortgage insurance. So they're putting a 10% deposit, and they're getting a 90% loan, and having the mortgage insurance waived. So it doesn't mean that they don't actually get assessed by the mortgage insurer, but they just don't pay the premium. So the policies of the mortgage insurer might apply, but they just don't have to pay the premium.
Are you seeing that now diminish slowly?
Definitely, yeah. So after COVID, a number of
Definitely
banks,
no entertainers.
funnily enough, there's that's still in existence.
It's in play, isn't it?
Yeah, that's right. So, the overall sort of doctors and with certain lenders, they've either abolished that or reduced the 90% lend to say an 85% lend. So,
Which is still something. Yeah, but it's not what it was yesteryear.
Mm.
So the other thing I wanted to talk about is productive debt and non-productive debt, and just how much it affects borrowing capacity. So, and what I mean by that is your credit cards, your car loans, your hire purchase, your Harvey Norman cards, or whatever it may be, because clearly that's a lot of people have a credit card or they have a car loan with its hire purchase or whatever it may be, securitized or unsecuritized. Yes. Explain to the listener just how detrimental that is to the overall borrowing capacity.
So if you've got 10K worth of credit card limit, for instance, that actually reduces your borrowing capacity with most lenders by around about 50K.
So it's a 5-to-1
Big hit.
ratio.
Correct,
And that
yes,
could be the
yes.
difference between getting finance or not.
Yes. And you can extend that, as you said, to consumer debt like car loans, personal loans, even student loans, so HECS, HELP, all that kind of stuff. But even to owner-occupied debt. So $500,000 of debt, if it's owner-occupied, it's actually treated differently to $500,000 of debt investment loan. So when I get the question, clients ask me, should I go the owner-occupied or the investment route? I can't answer that from a lifestyle perspective. It depends on your values and what's important and so forth. But from a financing perspective, from a lending perspective, taking on $500,000 of owner-occupied debt is going to be a lot more detrimental because with the investment debt, sure, you get a rental income. Well, in the owner-occ, you're not going to have to pay the rental expense. But the key with the investment debt is that you get a negative gearing add back. The lender offers you, like in many cases, assesses your income and says, well, Steve, you're on the 45% income bracket. So we'll give you some of the interest expense as an add back, meaning that you'll service better.
It's adding to the serviceability.
Correct.
Yeah.
Correct.
So the phrase there is add backs, and it's these little nuances which make all the difference when going for finance with the methodical, planned approach.
Yeah.
But just coming back to the consumer debt or credit card debt, whatever it may be. Typically, if you've got a credit card, there also might be car debt. So we start to really amplify the non-productive debt and therefore erode serviceability. But this is one of the reasons why, and to each their own, but this is one of the reasons why I'm not particularly a fan of the credit cards and the whole, scraping at the end of the month, using the bank's money, so to speak, because it's still a limit, whether it's zero or not, it's still a limit that erodes
That's right.
the serviceability. So whilst you might be saving money in some way, shape or form by using the bank's money for 30 days, you really need to know how much, or understand potentially how much eroding of your overall serviceability that it is. It's a cause and effect here. For every action, there's a reaction. So think very clearly about it, know where it's taking you or how it's.
It's a good point, and for all the points junkies out there, and I'm guilty of this as well. But if you're opening credit cards to get frequent flyer points, it's not a hell of a lot you can do with frequent flyer points at the moment, other than buy stuff, like goods and stuff. But you're starting to hit your credit file as well. So if you're opening a card, getting your 50,000 frequent flyers and then closing it in 6 months and then opening another card concurrently with that and, doing that, once every couple of months, sure, you're really sort of topping up your frequent flyers. But if next time you go for an investment loan or any other loan, you've got to be careful because every time you apply for a credit card, you're hitting your credit file. You've got to preserve that, especially if you're planning on growing a portfolio going forward.
Yeah, the credit file, and not a lot of people. So that's now a credit score, and
Correct.
you can get a copy of that,
Yes.
if necessary, via multiple different avenues. But if we just come back one step to the serviceability and the plan, if you were wanting to create a portfolio, let's say it was, over time, 5 properties, just plucking a number, then how being methodical is what we're always talking about. It's so important, not just from a strategy point of view and how you execute the strategy, but a big part of that strategy is actually the finance.
Yes.
And so having your broker involved every step of the way, even in your consolidation phase, whether that mean, is there a better product out there to get some liquidity or whatever it may be, is paramount. Do you actually see a lot of people that just go into this with their eyes wide shut in terms of finance?
I think unintentionally.
Yeah,
I think
unintentionally for sure,
A
yeah.
lot of people just go, oh, well, I bank with CBA or Westpac or whoever it is, and I'll just go down to that branch because I walk past that on my way home, so
It's convenient.
It's convenient. It's known. I wouldn't imagine that there's too much difference between one bank to another, and be that that might be the case, but the way that person, that lender, looks at structuring you and says, oh, this is the lowest rate, and this is fantastic, but you may not realize that may be impacting you because they're cross-collateralizing you, and they're fixing you in, and for you to be able to extract further equity or to be able to sell that property in the coming years might really impact you.
Yeah. So, and that's all you mentioned. They're different products, different banks, and maybe the way they look at you a little bit differently. And we see it time and time again where Bank A will lend you 700,000, and Bank B might lend you 1.2.
Yes.
Just on the way that they
assess
everything. So, what are some of the things that the listener can do or understand, or maybe a combination of both, to enhance their potential of borrowing?
Yeah, so borrowing capacity is really made up of what you're earning less what your expenses are and your commitments are. So assuming that you've got enough a deposit and collateral and your credit file's clean, then really it comes down to how much you're earning, what's your disposable income to be able to put towards more debt. So if we look at the income side, that's a lot harder because you can't control your income as much as you can control your expenses. But that is a critical part of it, because long term that's really going to dictate how much you can grow your portfolio and how quickly. So really taking the steps in the medium to long term to think about where your career is going, what your opportunities are, whether you're best served with your current employer or another employer, or opening up a business or what have you. That's a really important consideration. It's not something that you can change overnight necessarily, but it's something that you need to factor in as probably the most important. The other side of things is a lot more straightforward. So the expenses side. So looking at your living expenses. Now that's still scrutinized quite a lot, and probably not so much as during the height of the Royal Commission.
Yep.
But ever since that court case where Westpac beat ASIC effectively, and that was over how Westpac was treating applicants' living expenses. Look, the scrutiny's there, but it's not as tight as it was before. But making sure your living expenses are kept under check.
Mm-hmm.
So not unnecessarily kind of splurging and so forth, especially when you're in the months preceding to
borrowing.
Yeah. We spoke about it earlier, limiting the amount of total credit limit that you have in terms of credit cards, minimizing any other non-productive debt, so the student loans, the car loans, and so forth.
It'll be interesting to see, like with discretionary spending, and as you mentioned, the banks might be asking for the last 3 or 4 months statements, and are you at the club every day, are you eating out every day, or what have you. Yeah. It'll be really interesting to see how potentially serviceability may have increased over the last sort of 3 to 4 months, because nobody is going out, nobody is spending.
Maybe they're looking at the Uber Eats account.
Yeah, true. But it isn't there. So that because of, once again, mobility, which has an effect on the economy. So it's all encompassing.
Yeah. So there were quite a few changes that happened during the Royal Commission and flowed through. Yeah. And one of the standard approaches most lenders have is that if husband and wife are borrowing, they want both people on title, especially if it's an investment property. Are there ways of having just the one person on title and have both on the loans? Is it still possible in today's market?
Absolutely. Most lenders, I'll go as far as saying most lenders will actually entertain that, as long as you're giving a reasonable and rational argument as to why. And the big concern is that the lenders usually have with that is that, what's the benefit to the other party who's not on title, mm-hmm. but is on the loan? So it's a concept known as being a security guarantor.
Yep.
So and an income guarantor. Sorry, because and you and I as friends, we can't do that because, if I had the property in my name, we were both on the loan, the bank's going to say...
I didn't know we were friends to begin with.
Surprise. But the bank would say, what's in it for Victor? Like, why would he not be on title? Because if anything were to happen to Z, then Vic might be left with a massive loan, but no property behind it. So if it's an arm's length kind of relationship, then a lot of the times it's not going to be okay. But in a spousal relationship, you can argue tax benefits, things like income splitting. If you and your wife, you're on a higher income, and the property goes in your name because you accrue more of the negative gearing benefits, it makes sense. You can argue land tax, different land tax thresholds. So the benefit is that legally as a couple, you still jointly own the assets. So a lot of the times the banks will. I know there was a fair bit of pullback on that during the Royal Commission, and again overnight lenders just went, no, we're just not accepting that. But that was probably more of a knee-jerk reaction rather than a well thought out and considered thing.
So common sense has now prevailed. So, because family law precedes everything anyway,
correct,
right? So, and this is where when we sit down with a client, Steve, we do a loose strategy first with a client, and then of course we send them across to Z to say, actually get the finance plan right and the finance structure right first, and then we'll have another conversation to say exactly what the property looks like, right? Because these days you need to match the property to the finance, right? Most people, when they're investing, they're doing it in reverse. They're buying a property and then trying to then retrofit the finance onto it, isn't it?
Yeah.
It's an interesting point, because what happens is a lot of people, further to your point, is that they have this overarching goal about they want to purchase X, Y, Z, and they may have capital to support that to begin with, or the purchasing to begin with in terms of deposits and closing costs. But I find it really hard to understand how you can create a strategy without actually knowing what the finance component...
Without the fuel in place.
Yeah, without the finance component. And so there's no use saying, well, okay, we're going to purchase this, this, and this with a result of X, Y, and Z, unless we know what the borrowing capacity is.
That's a great point, because if you threw me over a client and the most suitable lender or the only available lender, for instance, didn't do construction loans, and you're like, okay, we're looking to buy this person a big block, we'll
subdivision,
make it subdivision, make
do
it a
that
dual
immediately.
income, and do it immediately. And then, we get the finance and you find the property. Then all of a sudden I tell you, hey, sorry, Vic, these guys don't do construction loans. Then it throws everything out the window.
Yep.
So
and that's why it's really important that you have open lines of communication to the broker, and if you have a strategist and an advisor, that they do as well. That there shouldn't be any sort of egos involved. This is a team effort. You could throw in the accountant and potentially a fin planner there as well, as we've talked about before. But if there isn't those open lines of communication, it might come down to something as simple as an accountant's recommending that you purchase in this entity. Let's call it a trust. And the broker says that's a great idea, but can't get finance for a trust this month or this quarter. And the advisor might be saying, well, they're both great ideas, but we need 1,000 square metre block to subdivide. Maybe it's both names. So those open lines of communication, I believe, are paramount. But I want to come back to the point around finance and knowing what it is before a strategy can be potentially fine-tuned is a way to look at it. You can have the overall strategy to begin with the advisor or yourself, but unless you know, once again, what the finance is, whom the lender is, what the product is, what the rate, what the LVR, and what capital you have to then reverse engineer for that moment in time, it's just throwing stuff against a wall and hoping something will stick.
Absolutely. Yeah,
it's counterproductive and I think quite dangerous.
Yeah, and it's one of the common traps that most investors fall into, is that they start pulling the trigger in terms of buying something, and then we'll sort out finance because we could always get finance. I mean, we're good income earners and we've got a big deposit, and they don't take into account the nuances of the financier in terms of, like you mentioned, construction loans. Yeah, that's a big one, right? And also in terms of the construction loans, what's the LVR they'll give you? Is it 70%? Is it 80%? Will they go into 90s?
But you could dig deeper. You could say postcodes.
Postcodes.
Therefore LVR positions. Therefore, maybe it might be your profession. High-rise development. Yeah, there's so much more to it rather than I earn $300,000 a year. I've got no debt. I should be cool.
Yeah, but then you've also got a $2,500 a month child maintenance fee, and $1,500 a week of rent. And so you can't service anything with the mainstream lenders. Right?
Correct,
So,
and that's it. And so let's explore that for a minute though, because that's a really interesting point. So we have our mainstream lenders. We'll call it the deposit taking institutions. So
yes.
the big four or thereabouts. Then we have our second tier lending.
Well, that's sort of, I think the second tiers are included in that sort of deposit taking sphere. The third tiers, or the non-banks, they're the ones that they don't have the full banking license with ASIC, but they do have a lending license. They have a credit license, right? So they source their funds from, it could be other banks, it could be high net worth, it could be overseas funding. But they have different rules applied to them because they don't have the same credit requirements imposed upon them by APRA. So they may be able to do things a little bit differently to the mainstream banks, the top two tiers.
They may look at the income differently.
Look at the income differently, look at your expenses differently, look at your existing loans differently. So instead of looking at your loans over a 25-year principal and interests, and a buffered rate, which might be 6.5% over 20 or 25 years, your repayments might be your deemed repayments might be $8,000 a month. They'll look at your actual rates. So you're paying 3.2% interest only. Sure, it's a fixed, but they don't mind. They're like, what are you actually paying now? And we'll split that up at $4,500. So all of a sudden your existing portfolio is costing you $3,500 more in the eyes of a mainstream bank. Where if you go to another lender, and the terms that they offer may not necessarily need to be exorbitant. In some cases, they're actually the rates are comparable, or in some cases even a little bit better. Generally, the fees to get in are a little bit higher. You're looking at about $1,000
Application fee.
Yeah, application fees, valuations, because they don't have the scale of the mainstream lenders to sort of give valuations for free or as part of the package that they offer you.
Mm-hmm.
And so once again, knowing what the outcome for the plan is, and therefore potentially the property will and could dictate what the lender is.
Yes.
It could be the difference between getting money and not.
And as we were saying, doing it with a view of the third, fourth, fifth property down the track, because buying the first three properties, you go, oh, okay, well, I might as well buy them as P&I because I get a better rate. But if that hamstrings you and doesn't allow you to get 3, 4, and 5, then
It's counterproductive.
Doesn't make sense.
Yeah.
Yeah, and a lot of it is crystal ball gazing, though, to be fair, in terms of the lending ecosystem and environment, because there's swings and roundabouts.
Yeah.
It literally was only 6 months ago that potentially the rates were going up. And it takes a virus to to bring the world to its knees in terms of the economies. But before that, there was something else. There was an election. Before that, there was a Royal Commission. Before that,
There's always a crisis, and with the crises, there are always opportunities. You just need to make small changes to your approach, and this is where good advisors come into play, because we are across these small changes, and we can then make sure that we're taking advantage of these small changes, because it's not business as usual right now in terms of finance, right? It is business in usual this week.
But is this
right.
But is this the new usual? Like to be fair,
I think so, because there's just been so many changes. If you look at the past decade in two halves, 2010 to 2015, there was hardly any changes. Like I remember brokers would have like a laminated piece of paper with the interest rates on them, and it didn't change for months, even years, a year or two, right? But And there was only one rate. It was like owner occupied was the same as the investment, was the same as P&I, was the same as interest only, was the same as 90%, was the same as 80%. Like it was just like it was easy. But if you look at what's happened over the last 5 years, like you said, APRA and Royal Commission and productivity and Sedgwick and Corona and everything, it is literally changing on a week by week basis, and lenders' appetites are changing, their outlooks are changing, so they're adjusting their policy. Plus, there's a lot more regulatory scrutiny, so they're
compliance and everything.
Compliance, and they're being made to change, even if they don't want to. So there's all these different forces that's applying on them, and that's why. Yeah, you're right. It's hard to keep up, and let alone for us, versus somebody who's not in the industry, looking at it day in, day out.
It reminds me of, I don't know how many years ago it was, and I won't mention the bank, but they were giving 95.
Which bank?
No, it wasn't that one. But they were giving, I think it was 95% plus LMI.
Yeah.
On, let's call it a Wednesday.
Yeah.
And prior to that.
Can't remember that.
And then on Thursday, they came out and they said, there is no more 95% plus LMI. We're dropping it down to 80% because we are responsible lenders. And it was like, okay, well, yesterday you weren't, and today you are. But really, when you dig down into that and try to understand what it was their book was full, and there were some major changes around the corner, whether that be compliance, or they were getting raked over the coals. Yes. Which before the Royal Commission, I think everybody knew what was happening. So they were trying to get everything in order. And it was just a matter of, well, we need to do whatever's right for their clients, for their shareholders, for longevity within the business. And so I think that's more of that to come. There'll be the handbrake will be sort of yanked up, it'll be pushed down. It'll be yanked up, it'll push down, and that'll be the flow of money from the powers that be all the way through down into the economy. Because at the end of the day, they need to lend the money to make the money. Mm-hmm. It's as simple as that.
And that's I guess a good lesson to your listeners is in that don't give up hope. It's just because a lender said no yesterday doesn't mean in a couple of weeks, months that it's still the same answer. Really, what you want to understand is how you can improve your position and work towards getting that yes. That approved.
I'm glad you said that, Sze, because one of the things that we do with our podcast is we like giving things away, right? So I'm going to mess up with your diary now. So for all of our listeners, if you wanted to have Sze and his team look over your mortgage structure and see with the changes that have happened over the last couple of months, what you couldn't qualify with in 6 months ago, whether there is a better product, where there is a better way of restructuring your loans. So if you're interested in taking that up, I'll be a bit gentle with you. So send your details to questions@rightpropertygroup.com.au, and we will pass it on to Sze and his team, and they'll give you a call and walk you through that as to how you can restructure your mortgage in today's market to get the best out of what you've already got, and perhaps even enhance your borrowing capacity doing it that way. So, sorry, mate.
Yeah, well done. You should. I don't know if the camera.
I lined him up really.
I don't know if the cameras picked up the facial expressions. Then from Sze, it was just like, what are you doing? It's but it's good because I think there is a massive difference between what you think and what is actually possible in terms of finance. I don't pretend to know it all for 1 minute, and it's changing daily, and I'm immersed in it every day, not from a broker point of view, but from an advisor point of view. And how many times a week do I ring you? In fact, I was on a meeting with a client last night, and on a Zoom meeting, and it just seemed that their rates that they were proposed were quite high from a different lender. Yeah. And because of my, call it OCD.
Your gut feel was right.
Yeah, and my OCD and gut feel, I rang you hoping that you would pick up the phone, and there was 0.7, 0.8 difference.
Yeah.
Just
small things like that.
Just like that. But that 0.7, 0.8 over circa $1.5 million worth of loan is a hell of a lot of money. Not to mention what it does to the serviceability going forward as well. So it all adds up. All these little bits add up. So get rid of your credit cards, get rid of your card debt. Did you actually, on that, did you see that the luxury cars, I think we talked about this on our Facebook Live, luxury car sales have had their best quarter in years and years and years and years.
Serious?
Yeah.
Oh my gosh.
But what that shows, and I don't know if we talked about this on the Facebook Live last week, but
I think it was the team meeting.
I was at the team meeting. What it shows is that, and I'm just rattling off names, call it Merck, BMW, Jag, whatever. They've had a really, really, really strong quarter. The people that are buying these cars, they're not going in there with a briefcase full of cash and saying, well, here's $150,000. I'll take the yellow one. This is borrowed money. And yes, it's got something to do potentially with the 100% asset write-off from the Fed. Yeah. But nonetheless, they've still got a service for the finance for the car. So there's an underlying element of confidence between their ears that they can afford to make the repayments. But there's also an element, of confidence that the lender's giving them the money, so therefore they think they're strong enough to be able to make those payments back. So everything may not be as what we think it may be.
Yeah. There's a lot of confidence in the market out there.
Or it's stress buying.
If you're going to go down, I'm going to go down with everything. So I'm all in.
Yeah.
So we're running out of time. So I just want to maybe 3 points. What can someone do and even if we're reiterating some of those points, what are the 3 strongest things that someone can do to enhance their borrowing capacity today?
First thing, think of it as a long-term game. Property investment's a long-term game. Work on your income. So I've kind of lumped 2 into that.
That only counts as one.
The other thing is get rid of all the non-productive debt, and including looking at your owner-occupied debt. It's necessary, but there are ways to restructure, which is a separate conversation, to get you into a position where you kind of minimizing that, but still not necessarily losing a lot of the liquidity. And the third is to select your lenders strategically, because certain lenders will be strong in certain points, which will help you with your future borrowing and your cash flow and so forth, and that will help you set up for your best finance structure going forward. Whether that is ownership or again liquidity and future borrowing capacity. So those are the 3: the non-productive debt.
I can't remember point 2, can you? We threw him at the deep end.
No. I was testing you to see if you were listening.
If we were listening.
All the others, Steve.
Yeah, I tuned out.
The mortgage restructure, and the third one was?
The third one was the income, and it's a long-term thing, and that's the most important.
Yeah,
we say that in jest, but Z is very experienced and very experienced. How long have you been investing for now?
10 years. Yeah,
10 years, and we won't go into how many properties because at the end of the day, that's all relevant to the individual. But double digits, which is good. And you've just bought yourself your principal place of residence.
Yes, bearing testament to your strategy, because this is was not scripted, but I started buying with you guys 10 years ago, almost to the day. You guys helped me build up a portfolio, and I know a concern of many clients is, if I start buying all these investment properties, does that mean I can't buy an owner-occupied because that's as important to me, or more important to me, maybe not now, but later. But that was something that I sort of took on. I took in faith that it would happen eventually, and I sort of built up the portfolio with your help. And 10 years later, I have gotten myself in a position where I've been fortunate enough to just buy the forever home. So, guys, thank you.
Fruits of your labour.
Yeah,
well done.
Yeah.
So there's a party at Z's place.
Yes.
When do you settle?
And you're all invited.
Yeah, everybody's invited. Social distancing rules apply, though. Well, that's it. We've done another fortnight/month of the filmed, videoed version of Investing Insights with Right Property Group. We really appreciate the feedback, so keep the questions coming. We have reams and reams and reams of questions, which we might do a podcast separately for that one. Once again, listen to it, watch it via the different social media platforms, YouTube, podcasts, iTunes, whatever it may be. And we will see you next time.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.